What is the best structure for a flip project? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. Flip projects, amazing projects, but how should you buy your flip? And should you be doing it in your own name? Should you be doing it through a company? What are the implications? Well, let's start with doing things in our own name, and let's get rid of some of those misconceptions, because there is a lot of them out there. Now, I have seen quite a few people over the years that have said, oh, it's fine, I'm doing it in my own name, I can buy it, sell it, and I'm going to pay capital gains tax on my flip. Now, technically speaking, that is incorrect, and unfortunately you cannot be buying property with the intention to flip it, sell it, and then you're paying capital gains tax, because unfortunately by your intention to flip the project, that would be a trading activity. It is not an investment activity, and because it's a trading activity, this means that that flip is seen as an income tax trading activity, not as a capital gain. A capital gain will only fit in when you buy a property, rent it out, or do something in that guise with it, and then you come to sell it at the end of the day, having had an investment property. If you're buying it with the intention to flip it and you sell it within 6 months, then unfortunately this is seen as a trading activity. Now, that's not a problem depending what other income you have and what else you are doing. So just because you say I'm doing a flip doesn't automatically mean that you need to do it in a company. It may be you can still do it in your own name. However, it does need to be treated as a trading activity. So on that basis, it will fall within the income tax regime, and you'll be paying tax at the 20 or the 40%, depending on your other income. So if this is your only income source, you've obviously got your personal allowance of $12,570 as it is in 2024, and that will be tax-free. Anything over that will be at 20%. However, it should be noted, because it's a trading activity, there will also be Class 2 and Class 4 national insurance, which Class 2 national insurance alters each year and is a couple of pounds per week, which probably equates to £180, £200 a year that you have to pay for your Class 2 national insurance, and Class 4 national insurance is at 9% and 2% as of 2024. Check out the rates with HMRC to see what the rates are today, depending when you're watching this video. So we're now paying potentially 29% on any of our profits on our flip over the 12,500. So this is where we kind of go, is it still worthwhile doing the flip in your own name? Now, as we've said, the flip is going to be taxed on the income tax rate, but it's only the profit that is going to be taxed. So this is something probably quite crucial to make sure we are happy with. So we bought the property, we've sold the property, we had some costs in between. We're only actually going to be paying tax on the profit. So if you've made 10,000, you're paying tax on 10,000. You won't be paying it on all of the income, all of the kind of sales proceeds without the costs coming into play. It's literally is just that profit that you are going to pay tax on. So if you've only made a small profit of 10,000, then if your income is minimal, you may still want to be doing it in your own name. However, if you're looking at making a 50, 60, 100,000 profit on a flip, then this is probably where you need to be starting to think about a company. Because in a company, you're only going to be paying tax at 19% or 25%, which means there's no Class 4 national insurance, there's no additional taxes. It is literally the flat rates of 19% for if your profits lie under 50,000, 25% if your profits lie over 250,000, or the marginal rate if it lies somewhere in between those. Which means you're probably going to be paying around the same amount of tax as if you were doing it in your own name if you do it in the company, but you're not going to be paying that Class 4 national insurance, So your tax rate is going to be hopefully at a lower rate for this flip project. So if you are looking at 50, 100,000, you're kind of getting into the 40, 42% in your own name, and that's quite a lot of money when in the company you're only going to be paying a maximum of 25% if you're going over 250,000. So it's actually going to probably be less than that you end up paying. So from a tax point of view, obviously it sounds like a company is probably going to be the best route forward. Now, I would tend to suggest you have a separate flip company. So this company is just doing those sorts of development projects rather than putting it in with your buy-to-let, your HMO projects. So rather than trying to collate everything into one company, I would tend to have this one separate because the risks of these things are slightly different. The SIC code that you have on your company is slightly different, and your lending requirements are going to be slightly different because you can't get a mortgage on a flip. You'll need to get some sort of bridging finance or private investment or something like that on your flip, compared to a property that you're buying and holding where you will have a mortgage in place because it's for long-term investment purposes. As a flip company, you can be doing multiple flips in that company. There is no issues with that unless you see any risks on any projects, in which case you may want to close the company down after the project is finished, and having closed the company down, you can set up a new company to then do similar sorts of things moving forward. So you may do 5, 10 flips in a company over a period of time, or you may just do 1 or 2 before you close a project down. For development projects, it may be you have a company per project compared to a flip company where you may just keep doing flips within that company over a period of time. Obviously, it should be noted there are costs to running a company, and we can't hide away from those. But hopefully, generally, there may be around the £1,000 mark, which is an acceptable cost to just ensure that you're not getting into those higher rates of tax to have to deal with. I know I've had conversations with people who have said, I'm just going to pay capital gains tax, it's fine, I'll get away with it, they won't know. And I'll just say, please do take caution if you are going to take that approach. It is incorrect, and the taxman are not stupid. If they see a property that's been purchased and is sold within 6, 9, 12 months, they do have databases, they have access to the land registry, and they can see some of these things are happening. So if they do come and ask questions, they can open up an inquiry on you as an individual and see what has been happening. And if they find that you've been putting something through as capital gains compared to something that should have gone through as a trading activity, they will come and seek the additional tax that's payable, and there may be penalties and interest on the taxes that should have been paid. So I will just say a word of caution there to please be doing things as you should be, as there is a risk that doing it incorrectly is going to open up a can of worms for you in the future if HMRC do start asking questions on something that you haven't done quite right. What's the best approach for a flip then? Well, I would probably say generally I feel a company is going to be the right approach for many people, because hopefully if you're doing it in the right way, you're doing projects where you're starting to generate a reasonable income pot, which if taxed in at the high rates of tax will be starting to cost money for you. Obviously, if you're only doing one small flip a year that's maybe making you 5,000–10,000, then you might kind of go, for the hassle of that, it's not worth having a company. And that might be a more practical application of it's not worth the extra costs of running a company, having a separate bank account, having all the admin that comes with running a company, and it may be just easier doing it in your own name. However, if you are taking things a little more seriously, you're looking at slightly bigger projects, maybe the 10, 20, 30, 50, 100k projects, then a company is probably going to be the better option for you rather than doing things in your own name. If it is your only endeavour and it's your only work that you're doing, then potentially it may be worthwhile doing in your own name for a short while, depending on the projects that you are touching. If you're doing the 50, 100 grand projects, then maybe that's not the best thing to be doing in your own name, as you will be starting to pay a reasonable amount of tax at that point in time. However, if you're only doing 1 or 2 small 10 grand flips in a year, then maybe doing it in your own name will work for you, and there is no reason to be not doing it in your own name. The only thing I would caution is make sure you're doing it correctly, make sure you're putting it through as an income tax expense, not as a capital gain, and then you're ticking all the boxes to do it correctly. And hopefully, if you've got no other income, you're using your personal allowance, you're only going into the class 4 national insurance slightly, so the tax impact is probably not going to be that dissimilar to if you were doing it in a limited company. The only way to know for certain is to obviously do the numbers and to see how much tax you would be paying in a company compared to how much you would be doing in your own name. If you've got other income, then it's all going to be at that 29% tax rate. If you've got your personal allowance, then you've got a bit more leeway, and actually doing it in your own name may actually work really well for you. So just because I'm saying do it in a company, for the majority of people, there may be some of you out there that doing it in your own name is still very much a good option for you. But make sure you do the numbers, have a look at how it all fits together, and as appropriate, ask for some support from your accountant and your tax advisors to hopefully just give you that confidence to make sure you're doing it in the right way. One thing I will just finish off with is, just because you did your last one in your own name or in a company doesn't mean that your circumstances have not changed. And if they have, it may be you do need to step back and go, well, actually, I could do this one in my own name rather than the company, or I can't do any more in my own name now, I need to do it in a company because I'm going to start getting taxed more highly. So key things that we're going to kind of finish off with are to really say, think about the risks. If there is risks associated to something, then get into a company, because that will help mitigate the risks and limit any liability. And the other side of things is the tax, and have a look at how you're going to be taxed on the different ones. And just remember, it's income tax, unfortunately, not capital gains tax. And make sure you're just taking that into consideration when doing your numbers. Hopefully today you've discovered how you should be buying your flips and what the implications are depending how you approach this. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing. Let's make tax less taxing.